Quantinuum just gave retail investors something they almost never get: public access to one of the most serious quantum computing companies in the world. The IPO priced at $60 per share. Quantinuum sold 28 million shares. The ticker is QNT. And the offering raised $1.68 billion in gross proceeds before fees and expenses. That sounds like the kind of IPO people want to chase. But by this production pass on June 10th, QNT was trading around $51.40, below the IPO price. So the real question is not, is quantum computing exciting? The real question is why a company with this much science, this much cash, and this much institutional history still has to prove so much to public investors. Here's the tension in 4 numbers: $1.68 billion raised in the IPO. About $2.26 billion of pro forma cash and cash equivalents, only $5.2 million of net revenue in the first quarter of 2026, and a $136.6 million net loss in that same quarter. That is the entire QNT debate. Huge capital, huge ambition, tiny current revenue, very large losses, and one more number most beginners will miss. After the offering, public Class A IPO buyers collectively own about 12.6% of the economic interests, assuming all common units are exchanged and the underwriter's option is not fully exercised. So if someone says QNT is the pure quantum stock, slow down. It is public access to Quantinuum, but it is also a complex IPO wrapper around a company still dominated by major legacy holders. That does not make it bad. It makes it a proof-gate stock. In this video, I want to answer 3 questions. First, what does Quantinuum actually sell? Second, why are investors so excited if revenue is still this small? Third, what would prove that QNT is more than an expensive science story? Stay with me until the ownership section, because that is where this IPO gets less beginner-friendly than most people realize. Start with the simple version. Quantinuum is trying to build a full-stack quantum computing platform. That sounds complicated, so picture a 3-story building. The bottom floor is the machine. That is the quantum hardware. Quantinuum uses trapped ion systems, which means it uses charged atoms as the foundation for its qubits. The middle floor is the software. That includes tools that help developers write, translate, optimize, and run quantum programs. The top floor is the application layer. That is where the company hopes customers eventually solve real problems in chemistry, materials, finance, optimization, cybersecurity, randomness, and other scientific workflows. The bull case is that Quantinuum is not just selling one piece of the quantum stack. It wants the machine, the software, and the applications to work together. If quantum computing becomes a major new computing layer, controlling more of that stack could matter. But here is the flip side. Building all 3 floors at the same time is expensive. It takes hardware experts, software experts, quantum scientists, manufacturing partners, customer support, and years of development before the market is mature. That is why this is not a normal software IPO. A normal software company can often be judged by revenue growth, retention, gross margin, and free cash flow. Quantinuum is earlier than that. The prospectus itself says no quantum computing company has successfully achieved broad commercial deployment at scale. That is not a bearish opinion. That is the filing telling investors the market is still early. So the first rule for this stock is simple. Do not confuse technical credibility with business maturity. Now let us make the technology beginner-friendly. A normal computer uses bits. A bit is like a light switch, off or on, 0 or 1. A quantum computer uses qubits. A qubit can behave in ways that let certain problems be explored differently than they are on normal computers. That does not mean quantum computers are magic. They are not replacing your laptop. They are not replacing every database. They are not automatically faster at everything. The promise is narrower. Quantum computers may eventually help with problems where classical computers struggle, molecules, materials, complex optimization, cryptography, and certain simulation problems. That is why the opportunity is so hard to value. The upside could be enormous if useful quantum workloads scale, but investors can still lose money if the stock market pays years before the revenue arrives. Quantinuum's technical approach is trapped ions. In plain English, it uses charged atoms. The basic argument is that atoms are naturally identical. If you can control them with high precision, you may get very accurate quantum operations. The prospectus highlights the Helios system and says its 2-qubit gate fidelity was 99.921% as of December 31st, 2025, based on a cited study and the company's analysis. For investors, the exact physics is less important than the business translation. Accuracy matters because quantum computers are fragile. If errors pile up, useful work becomes harder. So Quantinuum's bull case starts with technical performance. But here is the open question: can technical performance become repeatable customer spending? To answer that, follow the customer journey. Imagine a pharmaceutical company wants to simulate a molecule. It does not want a science fair demo. It wants a workflow that eventually helps researchers make better decisions. First, it needs access to a quantum system. That is the hardware layer. Second, it needs software that lets its team build and run the problem without being world-class quantum physicists. That is the middleware and developer tool layer. Third, it needs a domain-specific application that connects the quantum result to a real scientific workflow. That is where products like Inquanto and application libraries matter. Fourth, it needs confidence that the output is useful enough to justify repeat spending. That is the business model test. The same logic applies to finance, industrial optimization, material science, and cybersecurity. The product names matter, but the journey matters more. Hardware access gets the customer in the door. Software makes the machine usable. Applications make the machine relevant. Security and randomness may create another revenue lane. Quantinuum describes quantum origin as software that generates and distributes quantum-derived entropy for cryptographic use. In beginner language, randomness helps digital locks stay hard to break. So the company is not trying to be just a quantum computer in a lab. It is trying to become a platform that customers can use through multiple doors. That is the dream. But now comes the missing number. The filing does not give investors a clean product-by-product revenue breakdown showing how much revenue comes from hardware access, software, applications, security, or services. That missing number is one of the most important gaps in the whole story, because if the platform thesis is real, investors eventually need to see which parts of the platform are actually producing dollars. Now move to the IPO cash pile. Quantinuum sold 28 million shares at $60 per share. The gross proceeds were $1.68 billion. The prospectus table shows about $1.585 billion of net cash proceeds after underwriting discounts, commissions, and offering expenses. And on a pro forma basis, cash and cash equivalents were about $2.26 billion as of March 31st, 2026, after the offering transactions. That is powerful. You know, quantum hardware is expensive, talent is expensive, manufacturing is hard, commercial adoption takes time, cash gives Quantinuum a runway. But cash is not proof, cash is time. A full fuel tank does not mean the rocket reaches orbit. This is where the video changes from exciting to uncomfortable. For the full year 2025, Quantinuum reported $30.9 million of net revenue. That was up 35% from $22.9 million in 2024. Revenue grew, but the company also reported a $192.6 million net loss in 2025. in the first quarter of 2026, net revenue was $5.2 million, down from $19.1 million in the first quarter of 2025. Net loss was $136.6 million, compared with a $30.5 million net loss in the prior year quarter. Research and development expense was $54.7 million in the first quarter. Net cash used in operating activities was $62.9 million in the quarter. That is not a mature growth story. That is a cash-funded technology build-out. And that can still be investable, but it must be judged differently. It is not. The better question is, how much revenue proof does the company need before the market stops treating the losses as acceptable investment? That is where the ownership twist matters. Quantinuum Inc. is a holding company. After the IPO, its main asset is an interest in Quantinuum Holdings. Assuming exchange of all common units and no full exercise of the underwriter's option. Meanwhile, the Honeywell entities beneficially own about 47.8% of the combined voting power after the offering. Entities affiliated with Cambridge Quantum own about 31.8%. Think of it like a public front door attached to a building where the largest keys are still held by legacy owners. That can be positive. Honeywell's history can add credibility, industrial discipline, and manufacturing experience. Cambridge Quantum's heritage can add software and research depth. But beginners need to understand the structure. This is not a simple story where public IPO buyers own most of the economics and control most of the votes from day one. There are Class A shares, Class B shares, common units, reorganization transactions, and governance rights. None of that means the stock is bad. It means the stock is not simple. Now let us talk about customer proof. The prospectus names customer engagements with JP Morgan Chase in financial services, Amgen in pharmaceuticals, Mitsui and Company in cybersecurity, and Honeywell in chemistry. Those are serious names. They make the story more credible than a quantum company that only talks about theory. But a named engagement is not the same as a mature revenue engine. It could be a pilot. It could be a collaboration. It could be a technical validation project. It could be a services relationship. It could become something larger. The filing does not let retail investors see all the economics behind each engagement. So use a 5-step ladder. Step 1 is attention. A customer takes a meeting. Step 2 is a pilot. The customer tests the technology. Step 3 is a contract. The customer pays. Step 4 is expansion. The customer buys more or renews. Step 5 is repeatable unit economics. The company can serve many customers without losses exploding. Quantinuum appears to have real customer engagement. The stock needs proof that those engagements climb the ladder. That is why this video is not anti-Quantinuum. It is anti-lazy analysis. Now compare Quantinuum with the broader race. Quantum computing does not have one agreed winner. IonQ is also associated with trapped ion systems. IBM is a major superconducting quantum player. Google has its own quantum research track. Rigetti is public and superconducting. D-Wave is known for quantum annealing. Other companies are pursuing neutral atoms, photonics, and different paths. For retail investors, the point is not to memorize every technology. The point is that quantum is not one race on one road. It is a race with different vehicles. One company may have better accuracy, another may have better cloud access, another may have a larger developer ecosystem, another may be better at turning pilots into revenue. The best science does not automatically become the best stock. The best stock needs science, customers, economics, and timing. That is the hard part. Here is the strongest bull case. Quantinuum may be one of the most credible full-stack quantum platforms available to public investors. It has Honeywell-linked industrial roots. It has Cambridge quantum software and research heritage. It has deep technical talent. It has named enterprise engagements. It has a large post-IPO cash position. It has a platform story that goes beyond hardware into software, applications, security, and randomness. If quantum adoption accelerates, Quantinuum has a credible seat at the table. And if its full stack approach works, it may have more than one way to make money. Here's the bear case. Revenue is still very small. Losses are very large. The first quarter of 2026 showed both a revenue decline versus the prior year quarter and a much larger net loss. Product level revenue is not clearly visible. Customer engagement does not automatically equal repeatable revenue. Commercial quantum adoption may take longer than investors want. And competitors with larger ecosystems or deeper cloud distribution could capture a lot of value, even if Quantinuum has excellent technology. That is why valuation is so difficult. Normal earnings do not work because there are no positive earnings. Normal cash flow does not work because operating cash burn is still material. Revenue multiples are hard because revenue is small and uneven. So investors are really pricing probabilities. Probability 1, quantum computing becomes commercially important. Probability 2, Quantinuum's technology remains competitive. Probability 3, customers pay repeatedly. Probability 4, losses narrow over time. Probability 5, public shareholders keep enough upside as the company funds a long roadmap. Here is the proof gate checklist. First, revenue quality. Does revenue grow consistently or does it stay lumpy? Second, product level clarity. Can investors see which products actually make money? Third, customer expansion. Do named engagements become repeat contracts and larger deployments? Fourth, hardware execution. Does Quantinuum hit roadmap milestones without spending far more than expected? Fifth, loss discipline. Does revenue start scaling faster than operating losses? Sixth, ownership and dilution. Do public holders keep enough economic upside as the company funds a capital-intensive roadmap? Seventh, competitive position. Does Quantinuum's full-stack model win customers? Or does value shift to larger cloud and technology ecosystems? If those proof gates improve, the QNT story gets much stronger. If they do not, the IPO may look less like a doorway into quantum upside and more like a very expensive way to fund a long research timeline. Here is my final view. Quantinuum is not a meme with no substance. It is a serious company with serious science, serious backers, and a serious cash position. But serious does not mean de-risked. The stock is not just asking investors to believe in quantum computing. It is asking investors to believe that Quantinuum can turn quantum computing into repeatable revenue before patience runs out. So, the cleanest beginner summary is this. QNT gives investors access to one of the most credible quantum platforms in the market. But access is not the same as proof. Watch the filings, watch the revenue, watch customer expansion, watch the cash burn, watch the ownership structure, and most importantly, watch whether the quantum dream starts showing up in the income statement. This is not financial advice. Always do your own research.